Most accountants will recommend that companies be formed fairly early into the piece, and that's not all bad. The benefits of companies are, the main one being limited liability. So if somebody was suing you, in most cases there is a separation of identity from you from the company. That enables that if things go terribly awry, the company can be placed into liquidation, often without the main director being subject to personal insolvency or bankruptcy. Now, that's been the case for several hundred years and is really the foundation for businesses in the Western world. The problem with companies is regulation. The Corporations Act of 2001 is a voluminous document in excess of 1,500 sections and would extend to a couple of thousand pages. And the Australian Securities and Investment Commission, or ASIC as they are known, are fairly aggressive in ensuring that the directors of a particular company abide by their Corporations Act duties, or the directors' duties, and the rules can be often prohibitive. It's almost the quid pro quo of being given an advantage is that you actually have to act at a level which is considerably higher. A company, of course, needs to produce its own accounts, needs to have its own tax return, needs to have its own ABN. All of those things add to the complexity, and with complexity comes cost. The benefit of a company, though, in the form of asset protection is good. It's not great in that it does provide a separate means by which you can separate yourself from the business. They tend to be more expensive to keep, only because of the complexities and the need to produce accounts and tax returns of their own. And for a small company that doesn't do all that much, and the records are being kept by the directors or by the staff of the company, the costs tend to be around about $2,000 to $4,000 per year in accountancy fees. More, of course, the more complex or more involved or more active that company becomes. Most companies, for no other reason than it just seems to be industry custom, prepare accounts on an accruals basis, on an invoiced basis. And by that I mean if you send out an invoice, the GST and the income tax that flows from that invoice are attributable to the period when the invoice was issued, not when the invoice was paid or when cash was received. Now, that tends to mean you've got to be a little more clever in your accounting for those invoices, and that you must bring to account things as they happen rather than when they are deposited into your bank account. Cash is no longer the barometer for how your business is going. Now that adds another degree of complexity and means that you have to track debtors and creditors. It's sort of the big brother of structures. Companies tend to be established whenever it is that a trading enterprise is involved, whenever anything moves, as I call it. People, staff, animals, clients. Anyone who is capable of bringing an action in negligence, discrimination, any form of litigation, a company is generally the right thing. In saying that, companies are not the best structure for retaining or acquiring assets.